but that is not a good wealth building strategy. The result can be absolutely disastrous, or it could be really amazing. The very best thing you can do is to keep it simple. Hey guys, what's up? I'm Erin and welcome back to Erin Talks Money. Chances are at this point, if you've seen any of my other videos, you know that I am an avid investor in the stock market. And of course, there are definitely other places you can invest outside of stocks. You can do real estate or bonds or treasuries or businesses, etc. However, for me personally, I absolutely believe that investing in the stock market is the very best way to grow your net worth. And I know I'm not alone in this. I know there are many people out there who are eager to begin investing in the stock market, but they're just a little lost on where they should start. That's why I'm here. I want to help with that. I want to help break down all the confusion of investing in the stock market. So first off, what is the stock market? The stock market is a place where buyers and sellers come together in order to buy and sell stocks. And stocks represent actual ownership in real companies. Yes, when you buy a stock, you become a part owner in a company. And as an owner, you hope that this company does well so that your stock does well and appreciates in value. Now, back in the day, you would actually be issued a certificate when you bought stocks. However, today, everything is more or less done electronically. But the key takeaway here is that when you become an owner of a company, when you buy a stock, you are truly investing your money in that company. So you want to understand that business you are investing in. You've probably heard people say,
the stock market went up today, or
the stock market went down today.
And when they're referring to that, they're generally referring to the Dow Jones Industrial Average or Standard & Poor's 500, more commonly referred to as the Dow Jones and the S&P 500. And what these are is a popular collection of stocks, rather known as an index. Now, the Dow Jones is a collection of 30 large US-based companies, and the S&P 500 is a collection of 500 companies. And by taking a look at how these smaller collections of stocks did on a daily, monthly, or yearly basis, we can then make a generalization of how the stock market did as a whole. Okay, now that you know what the stock market is, why are people so eager to invest in it or to put their money in it? Well, it's one of the only ways that you can invest in some of the world's best, largest companies. And quite frankly, it's been incredibly lucrative. Historically, the stock market has been a really great investment. In fact, the S&P 500 has had an average annual return of about 10%. And it's very hard to find other investments that have such a robust return. You could put your money into a savings account, and if you're lucky, you could get 1%. You could do slightly better if you took advantage of CDs, and even better yet if you did bonds, but those have even only averaged a 5% return. As you can see, stocks are far and away the very clear winner when it comes to returns. With this increased reward comes increased risk and volatility. You probably know at this point that the stock market can have major swings both up and down. And just because we say that it has an average annual return of 10% does not mean that it is going to be a smooth ride. Far from it. Some years it could go up 20%, other years down 10%, and maybe the year after that up 5%. What it does in the short term is absolutely unpredictable. However, the market has proven to go up long term, and that's the important thing. Now you may be wondering, how do you invest in the stock market so that you ensure yourself to win big, aka get that 10% or higher return? Well, there are two ways. One is you can simply buy an index like the S&P 500 and hold it for a long time. Buying an index basically takes all the guesswork out of investing. You simply bought hundreds of stocks all at once, you have immediate diversification, and you don't have to spend any time worrying about which stocks you should buy and doing all the research. You simply bought them all. Or, number two, you can buy individual stocks and hope that they outperform the market in the long term. This is definitely the more risky strategy. It takes a lot of skill, a lot of knowledge, and yes, a little bit of luck. For the vast majority of people, buying indexes is definitely the way to go. However, if you are one of those very few, very rare people who can spot those unicorns, those Apples or their Amazons before they become the next big thing, you could certainly do even better than 10%. You could far and away double your money in the market, but it does take the very rare individual to do that. So how do you begin investing? As legendary investor Warren Buffett said, rule number 1, never lose money. Rule number 2, never forget rule number 1. So there you go, just don't lose money and you're all set. Okay, in all seriousness, how do you begin? Well, one, if you're a beginner or even a veteran investor, I absolutely recommend picking index funds. I know index funds are not as glamorous or as sexy as picking individual stocks, but they are far and away the less risky, more secure bet. You may think that you have the Midas touch and that you can select those stocks that are going to soar to the stratosphere. But remember, hindsight is 20/20. It's so easy to look back and say, yes, I absolutely would have purchased Facebook and Tesla and Amazon and Apple all before they became huge and I would be a mega millionaire. But remember, forecasting the future is incredibly hard. Even if you have a friend who's telling you about his major win in the stock market where he's doubled, tripled, or quadrupled his money, chances are he's not telling you about his losses along the way. And please keep in mind that even just 5% of professional stock pickers are able to beat the market over a 15-year time horizon. So remember, the odds are stacked against you. And I don't know about you, but I don't want to be in a game where I have to be in the top 5% in order to be successful. However, with all of that said, if you're still interested in investing in individual stocks, you absolutely can. The choice is yours. I just recommend that you learn how to analyze a company. Read over their financials, the balance sheet, the income statements, know your numbers, the earnings per share, the price to earnings ratio, etc. Look at their management team, assess any competitive advantages that this company may or may not have. You want to understand the companies that you are investing in. And if you do choose to go the route of buying individual stocks, there's no better platform than Robinhood because they offer $0 trades, 0 commissions and fees, so you get to keep more of your money and have it work for you. There's a link down below if you'd like to grab a free stock today, you can. Next up, you want to create a diversified portfolio, and that means you're buying a vast number of stocks and stocks in all different industries. Diversification protects your downside. What would happen if you bought just stocks in the automotive industry and that industry took a downturn? Your portfolio would also take a downturn. However, if you literally buy hundreds of stocks in all different industries, like through the purchase of an index fund, you protect your downside. Say 3 of those stocks don't do well. Well, it doesn't really matter. If the others do well, you would hardly even notice. Perhaps your investment would still be positive. That's the beauty of owning hundreds of stocks all at once. If 3 of them don't do well, but the other 497 do, well, you're gonna be just fine. It is actually very hard to diversify when you purchase individual stocks, as in you're probably putting the vast majority of your money in just 1 or 2 baskets. And the result can be absolutely disastrous or it could be really amazing, but either way, it's still much riskier. Next up, you want to be prepared for market downturns. They happen and they're never fun. Like the dot-com bubble of 2001 or the housing crisis of 2008 or even this year, 2020, the big market downturn we had. History does suggest that we do get at least 1 downturn a decade, so be prepared, they're going to happen. But that is why you should never be 100% fully invested in the stock market. You should always keep an emergency fund and you should keep any savings that you're going to need in the short term, say within the next 5 years, not invested in the stock market. You should keep it in a more stable fund where you can access it on the regular. You should be using like CDs, money market accounts, and just traditional savings accounts. Also, if and when the market does take its downturn, don't take your money out of the market. History does show us that the market does recover, it does rebound and go on to reach new heights. Ride out any turbulence you experience, keep your money invested no matter what the market conditions. Just look at this year, 2020. In just a couple months, the market went down 20%. However, here we are a few months later and it has fully recovered. Next up, you want to stay committed to a long-term investing strategy. When you invest, you want to be doing so for 10, 20, or 40 plus years. You would do yourself a favor to not pay attention to the financial news. At the very least, it is scary and terrifying. They are sensationalizing every single event, and remember, they are trying to make headlines, you are trying to make money. They are not trying to help you with your investments at all, no matter what they say. And you don't want to get caught up in short-term trading. Yes, there are people who do day trading, trading lots of stocks every single day, but that is not a good wealth building strategy. In fact, studies show that 80% of day traders lose money, and it's not an insignificant sum. The average loss is somewhere around 40%. Remember, in the long term, the stock market goes up. In the short term, it's anybody's guess. And finally, just begin investing. So many people are waiting for that perfect moment to get into the market. I gotta tell you, there is no perfect moment. Don't overthink it, just begin. The very best thing you can do for your net worth is to just start investing and leave your money invested for a very long time. That allows compound interest to do its magic. I know the stock market can seem like this scary, complex thing that we're not really taught about, but the very best thing you can do is to keep it simple. Get started investing, buy indexes, and leave them invested for a long time. There's no need to add any complication to it. With that said, I hope this cleared up a little bit about the stock market for you guys. I post new videos every Monday and Thursday. Please hit that like on the way out, ring the subscribe bell so you know when I post new videos, and I'll see you guys soon. Bye!